Hello and welcome to Money, 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 your weekly personal finance date with me, Surubhi Upadhyay. Now, if you've been tracking the markets, you would have been hearing a lot of the so-called taper talk. Basically, the fear that interest rates around the world, starting from the US, are about to rise. So is that going to bring about more market volatility? Stocks have already run up so much. Therefore, should you start thinking of increasing some allocation to gold? By the way, gold has underperformed. It's not done too much. In the last 1 year, it's down 8 to 9% in dollar terms. So the question is, should you think of gold? Well, to answer that, in the first half of the show, I have with me Feroze Azeez of Anand Rathi Private Wealth Management. Let's talk about the non-physical ways, the investment ways of buying the metal. There are sovereign gold bonds, there are gold funds, ETFs. We'll get to digital gold in a bit. Starting with sovereign gold bonds, paperless, what's working for them, what's not, the hits and the misses?
See, I think, Surubhi, our life has been made simple as investors, be it HNI, retail, or mass affluent. All investors can choose sovereign gold bond because the advantages are so overweighing the disadvantages that I would vote for it. Sovereign gold bond has this key feature of no credit risk because it is sovereign, as the name suggests. So that's very, very important. In any asset class where you're letting go of your money from your bank account to somewhere else, here you're getting a demat credit, and that is assured by RBI on behalf of the government. So which is a very, very important feature from an advisor standpoint. I would look at it as a very, very big plus. Second, it's an 8-year alternative. Of course, people generally are not so happy with long-dated lock-ins, 5-year minimum lock-in, but you can sell it in the secondary market. So that's liquidity is also taken care of. The interest which you get, 2.5%, is like a negative cost. Everywhere else, you have a cost. Here you have a 2.5% remuneration every single year for having invested. So that's as much as a real estate rental yield. So that's a big advantage. Capital gains being zero if held till maturity is a big, big one. And 20% if sold after 3 years on the exchange. So these are the few features. I think the only disadvantage is its lock-in period. There's no other disadvantage I can see. And that is mitigated by the liquidity which the exchange provides for one to sell. And the second part which you can do is pledge these and borrow. So there are enough merits which overweigh the demerits.
Oh, I hear you. I mean, who doesn't like a little bit of added interest? And that too, if I redeem the bond without capital gains, I mean, that sounds pretty good to me. But let's just sort of go a little deeper on the negative point. You said there's a lock-in. Unless I know how to trade this on the exchange. How does that mechanism work? How effective is it? I mean, is there liquidity? How do I go and buy or sell these bonds on the exchange?
See, I think liquidity is there. There's ample liquidity, but fortunately for the buyer and unfortunately for the seller, there seems to be a 1 to 2% discount. That's one thing which you have to mentally prepare in case there's an exigency and you want your money out. You have to be prepared to let go of 1-2%. Anyways, if you've held it for 3 years, you've got 7.5% of interest, 2.5, 2.5, and 2.5. If you gave away 1-2%, you're still left with a lot of money which you got extra than any other vehicle. So liquidity is immense and can be created. And when you place orders, those get executed as a broker. If one placed an order on your behalf, it'll get executed. And 1-2% kind of a discount is the maximum discount you see on bonds. But there's also a flip side. But the other side of the story is you can be a buyer. If there's a discount, it's a good news for the buyer, a little bad news for the seller though.
Okay, so that's all about sovereign gold bonds. Feroze, now let's talk about the mutual fund route, right? Now, mutual funds offer us gold funds and also gold ETFs. I guess the cost of investing in any ETF, including a gold ETF, would be very, very minuscule. But how do I decide between the two, gold fund or ETF? And, what are the bigger differences there?
I think the one big difference is gold funds are going to be more expensive than ETFs. Because gold fund is nothing but a vehicle which aggregates as exchange traded funds and gives it in the form of a gold fund. So gold fund, the underlying of that vehicle is nothing but an ETF. The advantage is that you can invest in the form of systematic investment plan, which ETFs would not permit. The other big disadvantage of ETF is that you can't borrow on them. Gold funds, you could pledge your units and borrow on them. So it provides for that liquidity without actually disturbing your core portfolio when you actually need money for short spans of time. So these are two very large differences. The third is when it's exchange traded, you have to pay a brokerage. But a gold ETF, there's no brokerage. The cost, of course, is higher on the gold fund side because of another layer of management which kicks in.
How much higher? What would the differential be, Feroze?
I think depends. There are 10 gold funds in the market with about 7,000 odd crores of AUM. The difference, average difference is about 37 bips, by which I mean 0.37%.
So there you go. I mean, if you don't have a demat account and you want to go the mutual fund route, then it is gold funds that you need to look at. These days, we love buying and selling online, right? With so many platforms, whether it's stocks, whether it's ETFs, or whether it's gold. So that's the option. But, we have to be realistic about the charges and the costs and weigh that in, in step, in tune with the ease. So what's your view?
See, Surubhi, I have 2-3 points which make me uncomfortable. One is the regulator not being there in the form of SEBI, which I think is a big detriment. The second is, of course, like Mr. Singh said, there is a trustee. Of course, most of these secured debentures of companies, when there's a credit risk event, also has trustees. So trustees is great, but a regulator is very important who actually looks at the audit report. So that's point one. Point two, if I'm holding a gold instrument for 3 years and if I spend 6%, 2% of my per annum return is gone, even if I hold it for 3 years. And my expectation is 8%, so I lose 1/4 of my total return. That's point two. Point three is opportunity cost. If there's another instrument, again digitally, which is marginally more inconvenient of calling a broker rather than digitally just clicking a button, if it gives me 2.5% extra as against losing 2%, that's a 4.5% difference. That's like 50% of the return expectation in itself. Would I compromise on my half the return just for the ease of one-time buying it? I think minimum ticket size definitely is a big win. 1 rupee as against maybe a sovereign gold bond at 5,000 rupees if we round it off. I think that's a very big winner. But I think not having a regulator is something which doesn't but it's very difficult to trust hard-earned money for the convenience.
Okay, fair enough. So this is a healthy debate we're having. Let viewers, make their own choice, and that's exactly what Feroze is helping us do. There are gold funds, there are gold ETFs, there is digital gold, there are gold bonds. I think the takeaway from the discussion is, one, you do need to have an added allocation to gold. Feroze, thank you very much for all the insights. And Mr. Singh, thank you so much for telling us how digital gold works. We hope that this has been beneficial to all our viewers. Thank you for tuning in. That's a wrap on this week's edition of Money, Money, Money. We'll be back next week with another thing.